Welcome to TheoTrade. This is Don Kaufman. It's October 29th, 2018, and you are watching the TheoTrade evening video. Let us start this evening's video after, again, another wild day in the markets. Let's start with a much broader and a much more fundamental question for the markets and see if we cannot come to a conclusion on this. And that happens to be, is this selling going to stop? You know, I know a lot of people do tune into these videos looking for some shorter term trade ideas, and absolutely we try to provide theirs, you know, where needed. Some of the guys trade a little bit intraday, and we've had just a wild and epic intraday trading session today with markets at highs, markets and lows. But I think we really need to start to focus a little bit more on the bigger picture, on that fundamental question. Is this selling going to stop? Or is this just going to continue to persist? Now, granted, I have been, bearish on the marketplace, but I want to show you some things that occurred today, right, that really have me concerned. And I want you guys to recognize that, listen, I recognize that this marketplace is just wildly oversold right now. I don't care what indicators you might look at. We have a TheoTrade RSI. You look at an MACD. You look at a Fibonacci. You whip out your Bollinger Bands. Okay, the momentum is clearly to the downside, and the markets are in a fairly hideous territory at this point in time. But that being said, is the selling going to continue? Is it going to persist through this? Do we need to be worried about those 401k IRAs? First and foremost, on a year-to-date percentage, let's actually snap the spiders to a year-to-date percentage. The spiders are now down. That's the S&P 500 is now effectively down. And again, I think it's worth highlighting this. Just about 1.8% on a year-to-date basis. Just again, taking a little bit of stock, if you will, of where the major indices are. The Russell, which shocked me today being down again, happens to be down, about 5% on a year-to-date basis. And last but definitely not least, the Nasdaq. And I'm using the Qs as a proxy for it. The Nasdaq now is only still up 3%. The reason I wanted to step back and start to ask that fundamental question is, again, I saw things going on in the market today that they do not bode well for the future of the marketplace. And this is not Don having a chip on his shoulder or being bearish. Clearly, I've been bearish for a long period of time. But let me take you into a little bit of depth regarding, the marketplace as a whole. So today, and I'm actually going to take you to some intraday trade. And on this intraday trade, to explain, again, a little bit of the longer duration, on this intraday trade, we started the day right off of one of our gravity points. And I was mentioning the gravity points in the weekend video. I've been talking about the gravity points, pretty much ad nauseum. We started the day pretty much at that 2682, and we were literally on it, skirting along the gravity point, came off hard and fast when the financials started to break down, and we literally came directly into the point 26, 26. I mean, right to the dime, we actually came to it, stopped, bounced, all right? There was wild sell-side activity before rallying back up into, again, the close. Now, it wouldn't surprise me in the after hours here to see us kind of, again, hit back right, in the after hours closer to that gravity point of the 2626. Neither here nor there. Clearly, you see some ugly sell-side activity, again, kind of persisting in today's marketplace. So why am I concerned, and why am I asking this fundamental question, is this selling going to stop? It's because today we saw really these wild, what I will term cyclical rotations into selling anything back into alignment with the broader marketplace. In effect, what I'm saying is there were a number of stocks that have been outperforming the market as a whole, specifically on a year-to-date basis. We could take Microsoft, for example. You could look at Amazon, right? And we can continue on to even to Google. But bear with me. I think the easiest example to kind of interpret would be to look at the Dow for a second. And I brought this up again on a lot of recent videos. We'll look at the Dow, and in a year-to-date percentage basis, the Dow happens to be down about 1% year to date. All you have to do, okay, is look at the primary component of the Dow, which is what? The single largest component of the Dow is Boeing. Boeing earlier today was up 21% year to date. What's being done now is they're systematically dismantling outperformers in the marketplace. Boeing now only being up 13%. People, it's a 7% drop inside of a day. Now, if you want to look at this towards the S&P 500, in the S&P 500, there are certain sectors that have been beaten down well before today's trading session. One of those happens to be none other than financials. The financials coming into Friday, obviously today is Monday, but coming into Friday, the financials were actually down 10% year to date. They got through the day unscathed. In fact, the financials ended up on the day 0.9%, which is shocking because I've been doing this for 20 years. I don't ever remember seeing the financials up at a point in time, and I'm going to tell you, the financials were still up on the trading session when the S&Ps hit 2603. Now think about that for a second. Why is that intimidating? Okay, why am I spending 10 minutes going into detail about who cares? So the financials were up when the S&Ps are down. It's because if you look at correlation, today here's the S&P 100. Now again, we've just closed a few minutes ago, and I just gotta really I gotta rail this into people of how dangerous of a situation you're in. It's the S&P 100. The advanced decline line is roughly 50-50 coming into the close today. 50-50 advanced decline line with the S&Ps down almost 30 handles, the Nasdaq down 160, the Dow down, 1%. Are you kidding? This is not a good thing at all. Okay? And when you start to look for signs of capitulation in a marketplace, you have to understand the capitulation looks like 99 products out of 100 down. Everybody is just chucking in the proverbial towel. It's not even close. What we're seeing again now is we've switched from that systematic and just hitting everything, and we've actually changed up to going back to cyclical rotations of sell side activity. That tells me a lot of these big quantitative firms, they're going back again, and they're systematically dismantling individual stocks and targeting them. Amazon, obviously, all right, listen, this doesn't mean that Amazon's going to be down every single day, but Amazon, was on the menu for today's trading. When I talk about the systematic dismantle, I think this is algorithms at work. You will never see such linear moves in a stock. I mean, you could draw a line, an absolutely, perfect linear example of algorithms attacking an individual product. Again, and as I say, systematically dismantling the products that are still strong on a relative basis. And now, as a trader, you want to start to think to yourself, what hasn't necessarily been dismantled just yet? One of the ones that kind of comes to mind, I've been looking a lot at United Healthcare. Why? It has nothing to do with the fundamentals. I don't even want to hear it. People are like, well, fundamentally it's sound. Do you think that a quantitative strategist cares? All they're looking at is the mathematics behind it's a $256 underlying. And, what they are going to look at is they'll cruise over and they will look at what is its weighting into the Dow. So here happens to be the Dow, and we're going to sort the Dow, by, here's the biggest price. It's Boeing. And then it's United Healthcare. And United Healthcare is the second largest constituent of the Dow. Now, Goldman Sachs has already kind of been dismantled. Apple has earnings. Give Apple a little bit of time because, again, Apple could very well be on the menu. We look at stuff like McDonald's, right? Why not? Look through this, because the outperformers like a McDonald's, that could be ripe for the plucking. Now, a lot of people will argue that something like McDonald's, that's going to be a very defensive underlying. Sure. But to bring down the Dow, and the only way to bring down the Dow, you can't hit one or two stocks. You got to hit the biggest constituents the hardest. And it doesn't matter if you are construing that as a defensive underlying. In the near term of this marketplace, okay, in the near term, first of all, the gravity points. I only have gravity points down to 25.75. I'm sorry. Why do I only have gravity points? First of all, gravity points, this is not like a predetermined study, okay? This is something I go back and do this ridiculous amounts of regression analysis. I'm sorry, but if we crack through 25.75, there's nothing below that. It would be nothing below. Well, come on. You got to go back this is all the way back into 2017, October of 2017, to find us even below 25.75. And these gravity points are based on risk rolling forward. So we need recent risk to be able to even figure out where that point happens to effectively be. We get under 25.75, believe me, Don will be working some late nights looking for more gravity points. Don't expect any more, though, below that, okay? But again, I strongly urge you, if you're not paying attention to what these gravity points are, you're missing the big picture, because all we have to do is pull up a 30-day 1 hour, and if you weren't a believer, you sure are now. We're just going to ping from level, okay, to level, pinging back and forth between levels, all right? And that's all that we've seen. And again, I'll point out, this marketplace is still way too efficient, still too efficient. Why is it still too efficient? Well, as I said, over the weekend video, if a monkey's picking out spots in the marketplace and we're hitting them spot on, you haven't seen ugliness yet. Now, to answer some of that fundamental kind of question, okay, is that selling going to stop? In the near term, maybe. It really does look like we're just hideously oversold. But in a marketplace that's getting whacked like this, okay, yeah, you look for the rip your face off rallies. Maybe you even get a week of a rally. I mean, like to the point where you're like, yeah, the buy the dippers are back. Fundamentally speaking, absolutely not. They're going to continue to dismantle this market piece by piece. That's pretty much what the advanced decline line kind of tells me today. This is not something that is necessarily going to go away. So, strap in, keep your helmet on. This could be a long time before this volatility diminishes. Again, 20 years of trading. You don't see markets, okay, that tank. Again, this marketplace was down almost 60. It was down almost 60 S&P points. But the financials positive on the day. And that opens up the door. Just that very idea opens up the door for there to be some wild sell-side activity in the future of the marketplace. We're nowhere near that capitulation that you want to see. Maybe short term, but longer duration, a lot of risk hold, and it kind of held ahead. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.